To remain updated with the latest business news, click on the bell icon.
Hello and welcome to this Business Today Market Special. I'm Uday Mukherjee. With me is my co-host Abha Bakaya and our guest for today, an old-timer from the market, a veteran of many bull and bear markets, Sanjeev Prasad of Kotak Institutional Equity. Sanjeev, great to see you again. It's an interesting time to get you on because the year has started with such a volatile fashion. Do you get the sense that this could be one of those years after two good years that we could even have a down year by the end of it, 2022?
It's possible. Anything is possible in markets, as you know, Udayan. See, the challenge for this year is the starting point is not that great. And you also have a lot of events on which, unfortunately, nobody has any control. So number one is, of course, valuations are on the higher side. When you're looking at the market, which is more like 20 times FY23 earnings. So that's clearly on the higher side. And more specifically, if you look at individual stocks, many of them are well above the pre-COVID levels. So you have a risk of deteriorating in some of the things as we go forward. Now, remember when I say 20 times, that is already factoring in the very strong earnings growth both in FY22 and FY23. So for FY22, for example, for the Nifty 15 days, we are looking at about 35-36% growth in net profits. And for FY23, we're looking at another 18% on top of that. But all that good news is already priced in the form of very expensive valuations. And on the negative side, of course, bond yields have already gone up, both globally and domestically. Looks like they will head up further. And I just hope in India we don't have a repeat of what we have seen in the US in terms of central banks suddenly making a big pivot on the whole inflation point, right? So as of now, we're looking at inflation being somewhat soft in the second half, but that's what RBI is projecting. God forbid if inflation is on the higher side and RBI has to raise rates much faster than what the market is assuming currently, then that also could be a big negative. And don't forget, we are in the middle of a big geopolitical crisis as of now. Who knows, what's the final outcome over here? So all the base case scenario obviously assumes that there is no, further deterioration of the situation in Europe with respect to Russia, Ukraine relationships, and things calm down hopefully over a period of time. But we don't know, and the clear risk is if something goes out of hand, if Russia actually invades Ukraine, all bets are off in that case. You could see a market which has a pretty significant downward in that case. Yeah, so the setup is not very good there, I would say.
How much downside do you see in the market, Sanjeev, in the event of this volatility continuing? Because so far we've had a correction which cannot be called deep even by a bull market correction standard, 7-8%, not much more than that. Do you think we'll get away with a cut like this, or could we be staring at something like a 20% correction, which would count as a deep correction? And in the past, in bull markets, we've had running 20% corrections. Do you fear this could be that severe a dip?
If you look at on the volatility point, day-to-day basis, depending on the news flow coming out of the US Fed or the Russia-Ukraine issue, you will have volatility in the market. But if you look at the Indian market, the last 6 months, it actually gone nowhere. It's pretty much at the same level, on a plus minus 5% basis. That's where the market has been pretty much trading. And I hope that's the case. Actually, that's not a bad outcome for the market, given where we are in terms of the starting point, as I was saying, valuation of rich. Many of the growth/quality stocks are trading at pretty rich valuation. So I think we have to go through a time correction. So that's not a bad outcome as we have been seeing in the last 6 months. A really ugly outcome could be things getting out of hand on the geopolitical side, which means you could have a pretty serious cut in the market. Whether they go down 15 times, which is more like 25% correction from current levels, we'll have to wait and see. But if you look at the market and if you look at the yield gap, which is what I focus on, currently you have 10-year G-Sec about 670 basis points, 6.7%. And your earning yield is, let's say, 1.20, so about 5%. So the gap is somewhere over 170 basis point. A good case situation for the market is, let's say, when the bond and earning yields are similar. But that will unfortunately only happen when the market corrects to 15 times, and from 20 to 15, that's a pretty big cut for the market. That's like an 8% cut. I hope we don't see that situation, but it's a possibility, definitely, given where we are in terms of the geopolitical issue that we are staring at, bond yields, which will definitely go up from where we are, and a lot of good news on earnings and recovery, etc., completely priced in the market.
the market itself has not corrected much, as we've been discussing, but the part of the market which has really collapsed is all these new digital IPOs. And that's the one which is causing a lot of discomfort for many of these IPO investors of 2021, whether it's the Paytms or Zomatos or now even the Nikas of the world. Do you think these prices have adjusted enough? The reset has happened, or do you see even more price erosion happening in these names?
The reason why the price correction is happening, remember, these are companies with very back-ended cash flows. So currently, many of them, barring Nykaa, they don't make any profits. It is expected that in the future they will make profits. And whenever interest rates go up, logically, you should also be working with higher, WACC or discount rate, which essentially means that any company which has very back-ended cash flows, you will see a deep dash in the or deep cut in the balance sheet of that particular company. So it's simple, DCFs, whatever is working out over here. Companies which have a lot more, upfront cash flows, if you increase the WACC by let's 100 basis points, you will not see that big a cut in the valuation. But any company with negative cash flows in the foreseeable future, a lot of value coming in the future and in the terminal value, you cut the WACC, your valuation goes down dramatically. So I suppose that's what is going on over here. People are just building in higher discount rates for the market in general and more specifically for these companies. Yeah, so that's a challenge. And honestly, on the price front, it's slightly tricky, to take a call in these companies because as of now, we really don't have too much of, visibility on, I wouldn't say visibility, but, when do they actually start turning profitable, whether it happens in the time frame with the market in the surging or things get pushed back for whatever reason that may be. So I guess the market will simply start assuming a much higher cost of capital or discount factor for these companies.
Sanjeev, are you keeping an eye on commodities? What's your view on crude with the backdrop of what's happening in Ukraine and the geopolitical scenario?
I assume some of the geopolitical risk is already priced in. But of course, the risk is something actually going wrong. And, then the Western countries coming in imposing some sort of sanctions on Russia in whatever form that may be. And I don't know how that affects, Russia's supplies of oil and gas because things are very tight as of now, as we know anyway. If you look at the supply-demand balance for crude for calendar 22, I should say, that is incremental demand is somewhere about 3.3 million barrels per day. Non-OPEC incremental supply would be somewhere about 2.7. So obviously you still have to depend on OPEC supply to rebalance the market. And for whatever reason, right, Russia supplies goes down, and that's actually the biggest producer of oil globally. So that can have a very dramatic impact on the market. I hope all that negative news is already priced in, and actually things cool off from where we are. On the positive side, we're actually starting to see some increase in shale oil production in the US. So if you recollect, shale oil production used to about 30 million barrels per day before the pandemic. It came down to about 11 million barrels per day, and it's been in that range for some time. Of late, I'm seeing it's climbed to more like 11.75 million barrels per day kind of a number. The hope is, some of the discipline which the shale oil producers have maintained on oil production, that will break and they will actually start increasing production as we go forward. So hopefully that results in some incremental, barrels coming to the market and cooling off oil prices. It's hope, obviously against Russia, it cannot offset any big decline from Russia, but hopefully we won't go down the path.
Sanjeev, we were talking about digital stocks earlier, but even mainstream IT software companies have corrected quite a bit from their recent highs. Do you think it's just a process of valuation compression because their valuations have expanded quite significantly, the Infosys and TCS of the world? Are they coming back to traditional mean valuations, or do you think it's a correction which should be bought into?
If you look at, let's say where Infosys was trading in the last decade or so, the stock was trading more like 15 to 18 times on a 12-month forward P. Maybe that was unjustified, maybe it's a lower side. But currently it's gone to more like almost 30 times on a 12-month forward basis. So what is the right number? Is it 18 times, which was the, growth until recently, or is it 30 times? Obviously, you have seen a step up in terms of revenue growth as also, for bottom line growth for Infosys, as also most of the IT companies. But does that warrant, that kind of rating? That's the question, and we have been playing around with our DCF models a lot, The problem with these companies, fantastic companies, obviously, profit-making companies, a lot of free cash flow, so on and so forth. But you just take the discount, rate by 100 basis point, and let's say 10 to 11%. The valuation goes on about 4-5, P, that is. Let's say from 30 it will become more like 24, 25 for Infosys. So that's a challenge that we are grappling with. I think this de-rating will affect just about every company as bond yields and interest rates go up. I don't think we can get away from that. And the fact of the matter is the de-rating was entirely led by very low bond yields, right? That was the case globally. That was the case in India also. Same if you look at TCS, similar situation. For a stock, it used to trade at about 90 to 22 times 12-month forward P. It's got ready to about 30 to 33 times. So clearly, I think some of these companies will go through de-rating. You've already seen some sort of a price correction in some of the names, about 10-15% correction from the peak this year itself. They may have to, or they may just go through a period of time correction, and as the earning numbers catch up, the valuation come down to more realistic levels, which could be more like, let's say, 27, 28 times for TCS, maybe 24, 25 times for Infosys. Maybe that may be the more right multiple, within quotes to look at for these companies.
The other blue chip I want to ask you about, Sanjeev, is HDFC Bank, because it rarely happens that the market does well for 2 years on the trot and HDFC Bank serially underperforms. I don't remember it happening in the last 10, 15 years. Is there something which is going on out there? Because initially it looked like it was just a process of some other stocks catching up, public sector banks, but the underperformance is not unwinding. Has something fundamentally shifted, you fear, in that blue chip name?
I don't think anything has fundamentally shifted. It's just that I guess people have more options, I guess, nowadays. Until recently, or let's say 2 years back, public sector banks were going through a terrible time. We had this whole corporate NPL problem, as in fact, most of the PSU were losing large amounts of money because the total provisions was significantly higher than their provision operating profit. And we also have some of the private banks like Axis, ICICI, even they had a lot of challenges on their hand. They were also facing the same corporate NPL loan book problem. So now you're put to a situation where the corporate NPL problem is largely behind us. Most of the larger banks don't seem to be that much affected by the pandemic, whether it's exposure to MSME loan book or to retail loan book, they seem to be doing pretty fine. So I guess in that context, we are seeing more relating of some of the banks which have struggled in the 2015 to 2019 timeframe. We have seen reasonably large rating of, let's say, an ICICI, SBI, some of the PSU banks also have late. So I guess that's what seems to be happening over here. I don't think it's an HDFC specific issue. It's more like people have more options as of now. And unlike let's say 2 years back when effectively only had a handful of banks which were doing fine given the challenges of the corporate loan book. If you look at how much it derated, this bank used to normally trade at about 3.5 to 4 times on your forward book. It's come down to about 3.2 now. So I don't think it's that bigger problem anyway. I mean, there have been some negative HDFC bank specific developments in terms of the credit card issues or the technology issues and so on and so forth. But I think the bank will overcome all these challenges. At the end of the day, it's a fantastic, very well managed franchise. Now, whether we see the rating happening from 3.2 to, let's say, wherever it was trading earlier, we'll have to wait and see. But remember, you are seeing higher cost of equity / cost of capital for every stock. So that may act as a headwind against any immediate rating for a bank like HDFC Bank, or for the matter, more stock, I would say.
Sanjeev, you have in the past spoken about rate sensitives and how those will come into focus, particularly with an eye on inflation and any possible moves by the RBI, as you also mentioned, when we first started conversing today. Would you still have that line of thought? Are you thinking differently, or are you still, positive when it comes to that part of the market?
Rate sensitive, I don't know how many are there which benefits positively. Obviously, banks do benefit from higher interest rates, because, given the fact that hopefully deposit rates will not rise that much, compared to increase on the lending side. Hopefully the NIMs will hold up, better. So that's a positive. Other than that, I really don't see too many things benefiting from higher interest rates. Just through the cost of capital route, everything will get derated to the right multiple which factors in higher, interest rates or bond yields, whichever way you want to look at it.
Okay.
Yeah, so I think that's a challenge for just about every sector, every stock, I guess.
Okay, so if we were to look at a neutral portfolio right now, how would you describe that?
In the sense,
as in, if one were to play it a little safe in a volatile market,
okay.
yeah.
I guess you stick with the usual consumer staples, some of the utility companies, although I may not like them from a long-term basis, or even some of the commodity companies, which at least in the more immediate term seems to have reasonably strong visibility or cash flow in earnings, and maybe that's how you try and protect the portfolio to the best extent you can. Banks also look good, I think, in this kind of environment, because at least looks like the NPL problem is firmly behind us. We will start seeing reasonable pickup in credit growth as we go along, particularly on housing and also manufacturing, and quite positive on.
Okay.
And as I was saying, the loan loss provision issue is largely behind us, so that should result in significant increase in the profits of the banks, and also some amount of rating in the multiples of the banks.
All right. So clearly, looking at the banking pie, and within that, would you segregate within, stick to the private sector majors? Would you also look for quality plays when it comes to mid-cap banking names, or would you stick to some of the key frontliners?
The frontline banks already seen some amount of rating, especially ICICI already seen significant rating. That has been a topic, pretty much over the last 2.5 years. Then what else? HDFC looks interesting, and including NBFC is also over here, because since we're quite positive with the housing cycle, and if you look at HDFC, also has been a relatively big underperformer, same as HDFC Bank. So its valuations have corrected to pretty reasonable levels. If you adjust for the value of all its holdings in various subsidiaries, it's available at about 1.8, 1.9 times 1 year forward core book, which is not bad, I would say, for a pretty big company like HDFC, especially when the mortgage side, cycle looks like it is turning. Axis looks like it could get rated further from where we are. Similarly, SBI also looks like to get rated further from where we are, looking at the fact that at least next 2 years doesn't look like something negative will happen on the NPL side, and you will start seeing a reasonably good credit book. So in that sense, I think whether it's the frontline banks, unless until the valuations are very high, which thankfully none of the banks at least seem to be sitting on very high valuation currently. Even the tier 2 banks should be in a relatively good position. And even the tier 3 NBFCs, some of the ones with weaker franchise, looks like the NPL problem is largely behind us. We could still have some pockets, where you will still have some challenges, specifically MFI loan book.
Okay.
But broadly speaking, if economic recovery kicks in as we are looking at, I think most of even the tier 2 banks and the tier 3 NBFCs, even they should be in a reasonably good position.
Okay, and within housing and real estate as well, would you have preferred picks or a preferred way to look at some of the options there? They're anyway just a handful, but would it be a bullish call across the board or a preferred plays?
No, pretty much across the board, because if you look at the housing market in India, it's not gone anywhere over the last 10, 12 years now.
Right.
5 major metropolitan markets, the total volumes used to be about 40 million square feet about 10, 20 years back. It is pretty much at the same level. So, after a decade of growth in the economy, I assume volume numbers have to be a lot higher. Plus, interest rates have actually gone down over this time frame. If you look at over the last 5 years in particular, mortgage rates used to be about 10% FY15. Currently, 6.5, 7, you will get a decent, a mortgage package, which means your EMIs could be down to the extent of about 15 to 20%.
Okay.
And lastly, prices haven't gone anywhere since the middle of calendar 15. So 7 years, no increase in prices, which means everybody has gone up significantly. So all the stars seem to aligning for the real estate sector. Volume numbers should pick up as we go forward, given the fact that FLBD has gone up, plus EMIs have come off pretty significantly. And I think after COVID, everybody probably realizes the housing is too small, and everybody wants to probably upgrade the housing stock. So I think housing cycle looks good. So you could just look at a basket of stocks over here, apart from the housing finance companies also.
All right, Sanjeev, great chatting with you today, and thanks for sharing with us a very detailed view of what you're looking at in this market, what's ripe in terms of opportunity. Great chatting with you, and look forward to touching base once again as we see how some of the current factors at play evolve.
Thank you. My pleasure.
Thank you.
If you like the video, do like, comment, share and subscribe.